Next up, we have Rashaad Tayob from Foord Asset Management, and he will be speaking about his outlook for interest rates and inflation in the South African environment, given that we know there have been massive increases in the petrol price and diesel, and certainly putting upward pressure on inflation. So, Rashaad, it's great to have you here with us today, and we look forward to what you've got to say, and I hand over to you.
Thanks a lot, Trevor. It's great to be here and talk about what is probably the most topical issue affecting markets at the moment. It's the impact of this energy price spike on SA inflation and interest rates. As you mentioned, the petrol and diesel price are a big factor in the economy and in everyone's pockets. So let's start off by discussing that. What I've got here is a chart, not of the oil price, but rather the benchmark price of diesel that goes in as an input into South Africa's petrol as well as diesel prices. And what I wanted to highlight is that it's not just the oil price that we've seen move up from $65 to around $100 a barrel. Because of the nature of the conflict and the war in the Middle East, a lot of refining capacity has been taken out. So the refining margin has increased from around $15 to $20 a barrel to it reached around $60 a barrel. And it's currently now sitting at about 40. So the refining margin itself has more than doubled. So while an oil price spike to about 100, 110 doesn't seem that significant, when you look at the price of the benchmark diesel, it had more than doubled. It's pulled back a little bit, but that tells you that it's not just about the headline oil price that's making a difference. It's also the impact on the refining margin, which means the underlying the spike that we've seen has been a more than doubling of effectively the fuel price, which has had a massive impact on the consumer and the growth prospects for the South African economy. Now, the issue, as we all know, is the closure of the Strait of Hormuz. And what we have seen is around 20% of global capacity has been taken out of the oil market. So the global oil market is around 100 million barrels a day. It's down by close to $20 million a barrel. And that had a massive impact all over the world. You can see some of the measures that have been put in place. Sri Lanka and Pakistan, poorer countries in Asia, are already experiencing severe shortages. We know that in South Africa, they've slashed the fuel levy. It's costing around 15 billion rands just to subsidize the consumer for the next 2 months, for a 3-month period. It's not necessarily sustainable. Recently, Trump also pledged to suspend the US federal gas tax. So this is having a massive impact on consumers all over the world. And we need the strait to reopen in order for the oil market to normalize. Now, what has helped and what has prevented a massive reduction in capacity, what has prevented an oil price spike of even bigger proportions? I think a lot of analysts would have expected maybe $150 or even $200 a barrel in this type of scenario. But what has kept that oil price rise is the actions of the United States and China. So the US has increased its exports quite significantly from around 5 million barrels a day to almost 8 million barrels a day. They haven't actually increased production, but what they are doing is they're running down their reserves, which is not necessarily sustainable. China has reduced its imports. China's a massive economy, but it doesn't have its own fuel supply, so it has a huge amount of imports, but it's also built up the biggest reserves in the world for a rainy day. And this is a rainy day, and they are running down their reserves quite rapidly. So their imports have fallen from around 15 million barrels a day down to 8 million barrels a day. That's a massive reduction in imports. And we look at the actions, the combination of the US increasing exports as well as China reducing its imports, that's what's enabled the oil price to move up only to about $100, $110 a barrel, as opposed to 150 to 200, which what would have been expected with an outage of this magnitude. However, this is not sustainable. The US can probably sustain exports for another month or two at most. And that's why you're seeing a lot of effort from Trump to end this war and get that strait reopened. China has a lot of reserves. They can probably run this towards October, November. But at some point, They have a massive economy, lots of people. And at some point, they will need to increase their imports again back to the original run rate, which is in line with what they demand. So we do need the strait to reopen and the war to end in order for the economy, the global inflation not to spike further and what would cause a global recession. You're seeing the impact all over the world. If you look at CPI indices, inflation is moving higher in the last few months everywhere. Recently in the US, the recent print was about 3.8% year on year. So well above the 2% target. The US has been unable to get back to 2%. It's now been almost 5 years well above that 2% target. And across the world, you're seeing inflation move up to levels, not quite the COVID spike levels, but levels we haven't seen since 2023. So a lot of global inflationary pressure building up. It's not only the oil price. A lot of commodity prices have been moving higher, and in fact, a lot of them have pushed higher even before the Iran war started. So when you look at agriculture, livestock prices, we know meat prices in South Africa have been moving higher, but across the world, the indices have been moving up. Energy has been moving higher since the middle of last year. Metals have been, you see copper hit new highs. Metals have also been moving higher. So it's not just the war and the closure of the strait and oil prices. The underlying inflationary pressure across the world has been building over the last 6 to 9 months. And now the oil price is effectively adding fuel to that fire. And because of that global inflationary pressure combined with global fiscal risks, that's governments which are just spending way more money than they're collecting, what you are seeing is the bond market selling off across the developed world. Long bonds, I've got here the UK, US, Japan, and Germany, four of the major bond markets of the world. And you can see the movement up over the last year. The UK is at the highest yields in almost 30 years. That is a very strong indication that a combination of inflationary pressure as well as reckless spending by governments, what you can call political instability in the UK with prime ministers changing every few years, incoherent government policies of tax and spend and borrowing, it's having a lot of pressure on the bond market. And it was not well placed. And now that you have an inflation spike, a lot of investors have given up on the long end of the yield curve and are looking for alternatives. So a lot of pressure on central banks all over the world in order to control the bond market, something we are used to in emerging markets like South Africa, but something they haven't had to worry about too much across the developed world. So bringing that back to South Africa, the chart I've got here is the year-on-year change in the rand oil price, and then comparing that to CPI. And what we see here is that the influence of the rand oil price on CPI has diminished over the years. So it was a massive driver in the 90s and 2000s. It has diminished, but it's still a very significant driver. When you have big changes year on year in the rand oil price, be it from a rand depreciation or be it from an oil price spike, if those higher prices are maintained, eventually it does feed through into higher CPI. So it's the fuel in the basket, but the energy is an input into a broad range of costs which go into the CPI basket. So we have seen a big increase, over 50% year on year rise in the rand oil price. And if it stays here, you would expect inflation to move substantially higher. What level, you might ask? How much higher are we going to move? What I've got here is a composite inflation forecast from the major economists in South Africa that we follow. And what you can see is that inflation is expected to move above the 4% level towards 4.5% and maybe a little bit higher, above 4.5%, and then come back down into 2027. But that is based on the assumption that oil moderates from around the $100 barrel mark down towards 80 by the end of the year and back towards $70 into next year. So South African economists, like the rest of the world, are making an assumption that the war is drawing to a close. The strait will reopen in the coming weeks or maybe month or two, and everything will normalize by the time you get to the third or fourth quarter. Now, that is still the most likely scenario. There's a strong drive at the moment to end that war, but we must remember that's not necessarily a given. So when everyone is assuming and when not a lot of risk is being priced in, it makes sense to be a bit cautious, because if the oil prices do not come back down to their historical levels, then inflation is not going to be sitting at 4.5% to 5%. You're likely to be into the 6s or even 7%. So this is almost your best case scenario. But you can see even there, it's substantially above what the new 3% target is. So it's a tough, it puts the SARB in a very difficult position, having just got the new inflation target. Now, the underlying drivers of inflation, I've broken them into two here. This shows you goods inflation as well as services inflation. Goods inflation in red, you can see, has been extremely low levels, falling even below 2% at some point, and it's pulling the entire inflation basket down. Services inflation, on the other hand, is far more sticky. And you can see that in recent months, even before the war started, it had bottomed out and started moving up towards 4% and now above 4%. 4.2% on services inflation, it's reverting back to its historical level. And it's an indication for us that the 3% level was not necessarily sustainable. A lot of things went right in 2025. The stronger rand, low oil price, a weaker demand. It helped inflation anchored and meant that inflation moved towards around the 3%, and then the SARB made that the new target. So it's one thing to get to 3%. It's another thing keeping it there. We think it's going to be quite a challenge. An example of some inflationary pressure which has been building, this is housing inflation, which is around 15% of CPI. And you can see that's been moving up from around the 2% level at the beginning of last year. It's currently up at 3.8% and heading higher. And that is a function of the weak economy, the lack of rental pressure outside of Cape Town. There's been barely any rent pressure. If you look at Johannesburg, for example, rents were barely changed for a decade while costs were rising. So that low level of inflation that we've seen in rents over the last few years, in our opinion, wasn't necessarily sustainable. And as soon as you saw a little bit of economic activity, you saw prices rising, you saw inflation, rental inflation coming through on a broader basis across the country last year. And it's reverting back to historical levels. So a big component of the basket is not pulling down inflation pulling inflation down to the 3% target. It's actually pulling it up away from the target. And that puts the SARB in a difficult position. Another example I'll give is medical aid inflation. GEMS, recently the government employees medical scheme, they recently increased their medical aid rates. They wanted 9.8%, then 9%. Eventually, they settled at 7.5%. So 7.5%, substantially away from the new 3% inflation target. Discovery has kept Discovery is the biggest in the country. They've actually had relatively lower increases for the last few years, but now you're seeing that normalize. And medical aids it's around 7 to 8% of the inflation basket. So a big component also now moving up at much higher level, much higher than the new CPI target. So, I mean, I've talked a bit about the CPI target, but our view has been that the stagnant economy has played a big role in containing inflation and moving it down towards that 3% level. We had low oil prices also play a role in the strong rand. All that came together. It was almost a perfect scenario for SA to get to a very low level, but keeping it at 3% is going to be very difficult. You've got high administered prices when you look at water, electricity, etc. When you look at wage increases across the board, unions, the mines, it's all at 7, 8, 9%. Nothing close to the 3% new target. And now with the oil price and the potential supply chain crisis, it's going to be very difficult for the SARB, having committed to this new 3% target, to keep that in place. And on the back of that, we are likely to see rate hikes. So this is what's priced into the market in terms of rate outlook. And you can see compared to 6 months ago how that picture has changed. The market was expecting rates. We're currently at 6.75 on the repo rate. There was an expectation of of a positive inflation scenario, enabling the SARB to cut rates by around 50 basis points, maybe close to the low sixes, which would have provided quite a nice boost to the economy. However, given the oil price spike, inflation outlook has totally changed. And now the SARB is committed, given it's committed to that new target, it has to demonstrate credibility by hiking rates. In our view, maybe 1 or 2 hikes, but the market's pricing in at least 3 hikes from 6.75 down to up to 7.5%. So 75 basis points of hikes priced in. I'm not sure it has to be that much, but unfortunately, they do need to do something to show some credibility and anchor at the new inflation target. So hikes as opposed to cuts are the new outlook for South Africa. The other factor which we want to highlight as a risk factor, which may cause an upset in the outlook, is the resurgence of the Phala, which can put Cyril under a lot of pressure if that parliamentary inquiry is set to go ahead. Now, Cyril is critical to keeping the GNU in place. And that's the GNU has been, and the fact that the GNU has been working better has enabled our country risk to come down, sentiments improved. And if you look at even the upgrade of outlooks on the rating agencies, a lot of that is down to the improvement in the GNU, which got off to quite a rocky start at the beginning. However, Cyril is very keen to avoid an inquiry because there's a lot of potentially underhand things which were pushed under the carpet. And if he's forced to testify, people from the farm, people from the police service are forced to testify, you may find that he might not necessarily last until the end of his term. I don't think it's something that he wants to go through. So this is something we're keeping an eye on, and it's a risk factor which we think the market is maybe ignoring. Now, when we look at the kind of risks that are building, the weakening of the inflation outlook and the very low risk premiums, we compare that to what the valuations are like. And what I've got here is the spread between South Africa's 10-year bond yield as well as the US 10-year bond yield. So a very strong rally since the election, especially last year. And we were in quite the sweet spot last year. We had the strong rand, the low oil price, higher commodity prices. So the terms of trade, when you look at our gold and platinum exports doing phenomenally well, and the GNU and political risks also doing well. So a lot of things went right last year, but a lot of that got priced in. So a lot of the good news is already in the price. The spread versus the US has come down from about 7 to 8% down to just over 4%. So we think with these much lower risk premiums, it makes sense to be a little bit cautious at this point in time. And if we translate that, I think the easiest way to look at it is how we position in the portfolios. What I've got here is the positioning of the Net Group Stable Fund. We've got a very diversified portfolio of a range of different asset classes which can deliver that CPI plus 4%, but with a low downside risk. And some of the changes we made over the last year include a significant reduction in fixed rate bonds. If you look at April 25 compared to just last April, the end of last month, and we've cut SA fixed rate bonds significantly into that rally. And what we have increased materially is inflation-linked bonds, especially on the short end. As I mentioned earlier, we saw a lot of inflationary pressure building even before the oil spike. There was a lot of fundamental underlying inflationary pressure. We thought the market was very optimistic in terms of pricing in the new inflation target as if it's a done deal, as if it was easy to achieve. We felt there were going to be a lot of challenges in the coming period. And in fact, it was just a few months later that the challenges materialized. So inflation in bonds being able to lock in real yields of 4 to 5%, we felt provided a very good anchor for a stable type of portfolio alongside its full range of assets. So Trevor, with that, I'll hand back to you for any questions on what I've discussed.
Great, Rashaad. Thank you very much. Certainly some interesting comments. And I must say, I mean, from my side, it's really frustrating, I guess, that South Africa at the beginning of the year was doing amazingly. It looked like all the pieces on the chessboard were aligning. We had ratings improvements. We had the rand was strengthening. Inflation was really low. Our growth was improving. And things were looking really good. And then, I guess, pretty left field, this Middle East war broke out. So, Rashaad, in terms of that, and really taking some of the comments you made in your presentation, assuming inflation does rise, and as you've said, the Reserve Bank potentially is going to do 2 to 3 interest rate hikes, what is in reality, the effect of that on actual economic growth or GDP growth in South Africa? Because obviously that's critical for this country, for employment, and I guess will even have an impact perhaps on the elections this year, the municipal ones, and in 2 years' time. So can you just talk a little bit about the actual impact of higher inflation, interest rate hikes, and what that ultimately lands up doing in terms of GDP growth?
Yes, so as you mentioned, we start of this year, we came in with great expectations. So growth was going to experience a recovery. We were looking at numbers in the high ones, even 2%, which if you look at the last decade, we've struggled to even grow at 1%. So this was going to be a recovery year. If you look at the Fed budget, this was also going to be the peak in the debt to GDP ratio, and it was going to fall back this year. And there were a lot of expectations that after almost a decade in the doldrums, some things were beginning to work. But unfortunately, the war, the spike in the oil price, and the knock-on effects of higher rates, higher inflation, has probably put our recovery, knocked it back to 2027. So I think if we do see, but that's also very dependent on whether the war can end and the strait can reopen and the oil prices can basically revert back to its old level. So I think if that happens, the economy should do okay this year. But I don't think we're going to see what people were expecting in terms of high 1% or even 2%. I think there's a lot of issues that have to be sorted out, and we will still have to contend with 1 or 2 rate hikes, as well as this energy cost. And if I mentioned the 15 billion rand that the Treasury had used to cut on the fuel levy in order to help consumers. So that's also knocked back it will increase the deficit slightly and make the consolidation of the budget a lot more difficult. So all of this has made 2026 a lot more difficult than most people had expected it at the end of the year. But these risks all materialize, trade wars, real wars, these things happen. And that's why when you're looking at assets, you do need to have risk premiums. You need to be compensated for not only things that you expect, but also things that you may not necessarily expect. And that's how we look at portfolios and how we look to construct robust portfolios so that they are resilient to times like these. So I think that 2026 is going to be a more difficult year. But if we do get a normalization and the strait reopens and the oil price normalizes, I think that the recovery can be pushed through to 2027.
Rashaad, so just to end off then, what really briefly, in your view, is your biggest takeout out of this Middle Eastern war? I mean, for me, of course, we've suddenly all become experts on the Strait of Hormuz, but we've understood now that it controls like 20-25% of the world's supply of oil and gas, etc. Coming out of the consequences of seeing this type of a conflict now and the effects it can have, what would you say should be the world's learning, I guess, of this, and if not South Africa specifically?
I think one of the things that the world's definitely learned is that the importance of securing supply chains. So it was shown during COVID, it was shown during Russia-Ukraine, and now we've demonstrated again that it's important to be able to have your own oil refineries. In South Africa, we had many oil refineries, and we're now down to one working one and one semi-functional one. So, and it's not just us across the world. Australia's got no refineries anymore. So a lot of the world has been very dependent on other parties, be it the refineries in the UAE, be it the refineries in China. And I think it's important to look strategically at your own, what are the economic risks that you're facing as a country, and how can you secure some of your own supplies? I think that's one critical thing that the whole world is going to be looking at going forward. The other one I think I'd point out is the geopolitics and the competition for global the other thing I'd like to point out, I think the geopolitical shifts that we're seeing are quite fundamental. It's something we've been highlighting for a while in terms of the de-dollarization. It's a reason why we have gold in our portfolio, as people are viewing it as an alternative currency, and the rise of China as the other major force in the world. And the actions you're seeing driven by the United States and some of the which are generally getting a bit more aggressive and maybe not as well thought out. And I think that it does indicate that you are going to see a more volatile geopolitical environment going forward as we move from a unipolar world where the US was the dominant power in the world to multi-centers of power, including China, including Russia, including areas in the Middle East. So it's not just going to be a unipolar world. And I know that's being said, but I think this is another data point that we get, that we are moving to a more difficult geopolitical global environment.
Rashaad, great. Thank you very much. I think we're out of time. Some really interesting insights from you, and we appreciate it. And that actually brings us now to an end of today's multi-manager webinar. It's been great having everybody on board, and a massive thank you to all 4 speakers that we've had. We hope that you have found it interesting, worthwhile, and informational. So thank you very much to everybody that's been dialed in for the last hour and a half. We look forward to hosting you in our second webinar that will be in the second half of the year, where we will have another amazing lineup of interesting and topical speakers. So until next time, thank you very much and have a great rest of the day.